Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now it's FX Tuesdays and today we're going to talk about the New Zealand dollar, or as it's most popularly known, the Kiwi. Why the Kiwi? Well, the Kiwi bird, as many of you might already know, is a flightless bird native to New Zealand that is pictured on the side of the $1 coin. Now, the Kiwi bird is a national symbol of New Zealand, which oddly enough gained popularity through sports, with cartoonists starting to use the Kiwi bird to represent the country's team in rugby matches around the start of the 20th century. Today, of course, in currency markets, it is used fondly to refer to the New Zealand dollar. Now, regular listeners will know that we are big fans of commodity currencies because they are supported by both rising interest rates and high commodity prices. Now, these have been factors behind a positive view on both the Canadian dollar and the Aussie dollar, but we do believe the Kiwi dollar should not be ignored either. Specifically, we believe the Kiwi looks interesting today from 4 different perspectives. First, a central bank has been a leading actor in the current rate hiking cycle. Since the pandemic low policy rate of 25 basis points, the central bank has hiked rates by 1.75% to take the rate to 2% today. This, of course, makes the currency more attractive not only from a yield earning point of view, but also helps it stand up against US dollar strength, especially if the Fed expectations start to cool. Now, second, of course, there may be more in the offing. If you look at the economic data in New Zealand, its CPI inflation rate was last reported at 6.9% for the first quarter, which was a 30-year high, and the unemployment rate was at a low of 3.2%. Now, both arguably offer the central bank plenty of room to tighten policy further, albeit with the one weakness that both data points are released only quarterly, leaving policymakers with a slower pace of feedback on the effectiveness of their policy tightening. Now, third is New Zealand's characteristics as a commodity exporter. Commodities continue to be New Zealand's largest export, led of course by dairy and meat products. China is one of its largest export destinations alongside Australia and the US. Now, what this has meant is that China's lockdowns and slowing economic growth have been a drag on the currency. However, it does look increasingly likely to turn into a positive as China's largest cities emerge from the most acute phase of lockdowns and policymakers in China turn their attention to supporting economic growth. Finally, one can't ignore the Kiwi's correlation with the Aussie dollar. What this means is that further strength in the Australian currency, especially if the central bank there raises policy rates further, could turn into one additional source of support for the Kiwi against the US dollar. Now, it has been argued that despite all of this, the Kiwi may have less room for upside compared to other commodity currencies because the central bank has less room to surprise on the upside given how much it has already hiked rates. Now, while we'd acknowledge this risk, we do believe the 4 factors we just discussed can more than outweigh this, with the recovery in China's economy possibly being one of the more significant positive factors. Now, that's of course all the fundamental factors, but from a purely technical point of view, we do see the NZD-USD currency pairs break above and subsequent defense of the key 65 cents level being quite significant. Now, this level is significant in our view because a successful defense and perhaps a subsequent break above the 66 cent level is likely to turn the short-term technical outlook quite bullish in our view at least. The defense of that 65 cents against the dollar level is quite key though, and we'd see any relapse back below this level as likely to soften the outlook. So, the Kiwi currency is one idea that we think looks interesting at this point in time, but we'll take a pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.